We are live. We're coming at you from myself personally. I'm here from Aliso Viejo, California, a little suburb nestled next to Laguna Beach. And I am with JC Peretz, the founder of allstarcharts.com. And he is nestled in a little town just on the very, very edge of Pennsylvania, about an hour and 15 minutes from downtown New York City. Is that right, JC?
It's about right, depending on what time you leave.
Yeah, that's a good point. Same here in Orange County. Everybody asks me how long it takes to get somewhere, and I go, well, that depends, my friend. That depends. All right, so we're back. Last week, we had a great update. We're coming right off of your monthly chart review. JC has a very, very big business of helping people use technical analysis to find what's going to happen next in the marketplace. And with volatility as high as it is, there are opportunities everywhere, as well as landmines, and you're helping us navigate it. We're back with another exciting week to talk about what's happened, what are you paying attention to, and what do you see coming at us next. We actually have, seen some interesting things happen this last week. Why don't you tell us what your, prognosis is and what you're watching and kind of some of your thoughts?
Yeah, so, for me, it's a weight of the evidence thing, and it's a sum of the parts. What people forget is that it's a market of stocks, not just a stock market. And that really just, people forget, right? It's you ask, even you and me, you ask me, hey, JC, what the market do today? I'll be like, oh, Dow was up, whatever it is. It's just our habits. But the truth is there are 30 stocks in the Dow Jones Industrial Average. There are 500 stocks in the S&P 500. There are 3,000 stocks in the Russell 3000. It's a market of stocks. So we were super bullish since last summer, buying stocks, buy everything. Why were we so bullish? Because more stocks were making new highs. More countries around the world were making new highs. More sectors in the U.S. We were getting that rotation. And then people would ask me, like, JC, the sentiment was very poor, in the last 6 months of last year as the markets were driving higher. It's like, JC, what's going to get you bearish? It's like, well, when fewer stocks stop making new highs, when fewer countries are breaking out, when fewer sectors in the U.S., that is going to happen before the indexes peaked. So what happened at the end of January, early February? Fewer stocks were making new highs. Advanced decline line started putting in lower highs. Small caps stopped making new highs. Mid caps, micro caps, transports, the value line geometric index, none of them were making new highs. Divergences all over the place. So that information alone doesn't tell us how severe the correction will be, but it's certainly enough to get the hell out of the way, because if stocks are going sideways or down, either way, we don't want to own them. So what happens next isn't necessarily our problem. I would have never told you that the stock market was going to drop 35-40% in a matter of weeks. But we did know to get the hell out of the way, kind of like a bull, like in Spain, like ole. And then, now it's somebody else's problem. Okay, fine. So that was then. Now, what are we looking for now? Flip the script. It's the exact opposite. We are looking for fewer stocks making new lows, fewer sectors making new lows, fewer countries making new lows. And in fact, we want to see an expansion of stocks not making new 52-week highs, because we'll be waiting forever. But let's start with the basics. Let's start with new 10-day highs, new 21-day highs, right? Those are the first things you're going to see way before the breadth improvement shows up on the new 52-week high list, which eventually one day will happen, but not anytime soon.
Yeah, you had a great post a blog post, allstarcharts.com, and it was what I tell my friends and family. And you and I have been going over this chart, so I wanted to get an update from you. We've been going over this chart, and it's one of your favorites. It is what's the percentage of the stocks in the New York Stock Exchange that are trading above their 200-day moving average? Can you give us an update on how that's looking?
Yeah. So
and also, just for people who are now joining us, what that means and why this is important.
All right. Are you able to see that screen, Jay?
Yeah, man. I got you.
So basically what this is, when you talk about stocks above their 200-day moving average, it's sort of a lazy way to say stocks in an uptrend. Because I think we can all agree, if a stock's above its 200-day moving average, it's probably not in a downtrend, right? I think we can all agree with that. So fine. So now we want to see the percentage of stocks on the New York Stock Exchange that are above their 200-day moving average. Now, why the New York Stock Exchange? Jeremy, a lot of people are not aware of this, but the New York Stock Exchange has a lot more international exposure than something like the S&P 500 or the NASDAQ 100. In fact, more than half of the largest 100 companies on the New York Stock Exchange are actually foreign stocks, right? So there's a lot more international exposure. So you're going to get a much more broad-based measure of the stock market by looking at the New York Stock Exchange, as opposed to looking at the NASDAQ 100, which is going to be a bunch of big fat tech stocks, right? So while that's good information, it's not necessarily the information we're looking for in this particular moment. There are different tools for different environments. Like, we're not going to brush our teeth with a hammer, right? We're not going to hang a mirror on the wall with a toothbrush, right? For different environments, we need different tools, right? It's no different in the market. So we're looking at the percentage of stocks in uptrends on the New York Stock Exchange. Now, this particular tool is not very helpful in a bullish environment. Again, hammer and toothbrush. This is a better use for this tool, in my opinion, is in a downtrend, right? So we don't want to be buying stocks when it breaches below 15%. The buy signal is when it gets back above it, and we're flirting with those areas. And we should be getting confirmation of that next week. But let me just show you what we're going to see before that, right? Because that sort of breadth improvement is the outcome. That's the resolution ultimately. But there are things that happen before that, right? You don't just, like, I hate to put it in another way, like, you're not just going to die. Like, something's going to start going wrong with you, and then eventually you're just going to pass away or whatever it is. You could see it coming. Like, I just did a blood test, right, for a doctor that they can see like calcium deposits that 20 years from now might be heart disease, right? And they can start spotting the beginning of that 20 years ahead of time, hypothetically. Like, so far I haven't gotten the results, but my point is they can see that ahead of time. In market breadth, it's kind of very similar. You could start to see slight improvements before that ultimate sort of evolution. And here we're looking at the new 10-day high list, which is like, this is like first grade for uptrends. Like, this is like the beginning, right?
Yeah, right.
We have mathematically for the stock market to go up, more stocks need to go up. That's just, basic arithmetic. So if we start to see an expansion of stocks making new 10-day highs, new 21-day highs, new 63-day highs, that is the evidence that we're looking for to suggest we should be more aggressive in the stock market and less picky, which right now we have been much more picky in terms of, like, our universe of stocks that we're even willing to look at has been like 60 stocks.
Yeah, right. And we're heading, I'd love to hear if this is what you see. I think we're heading into some strong resistance now, right? With this fall that we've had in the last month or so because of the coronavirus. The market has definitely been in a downtrend. However, in the last week or so, we've seen some more, as you're saying, the very elementary stages of a little bit of a rally. A lot of people are calling this a dead cat bounce. Some people are saying, no, this is the start of it, with the Fed putting in a nuclear bomb or an atomic bomb of Fed stimulus into the system. And we start to hear little things like, the government releasing these small business loans, the PPA program, actually getting funded for that. And this is supposed to be the worst week of this whole, crisis. That things could potentially turn around, but I see you're about to go into this. We're about to see, we're also heading into some resistance here. What are you seeing?
So remember, all this stimulus stuff and the Fed and all that stuff is great, like in theory, but it's not your opinion or my opinion that matters in terms of whether we agree with what they're doing or not. The real opinion is what the market thinks of all of that information, right? That tsunami of money, like, maybe it's enough, maybe it's not, but the market is the ultimate arbiter, right? Which is the point that I want to stress, which is why we don't really care what the journalist thinks. We don't really care what, we read in the paper. We only care what the market thinks about that, right? And that's the only real truth that we can actually trust. So what's going to happen next? I have no idea, right? But the good news is that nobody knows, right? It's a level playing field, which I think also gets forgotten. Now, here's a good one. These are the regional banks. Regional banks peaked in December, okay? I don't know, I have the power to do this. Regional banks peaked in December, well before 2 months before the S&P 500 and NASDAQ and Dow peaked. So we see this as a leader, most definitely. Helped get us bearish at the right time, and I think will help us get bullish at the right time, or be even more bullish, right? And for me, it's this 35 level. This is a close-up of the consolidation that's been taking place as we speak. These are regional banks. That's $35 level on the KRE. It's the regional bank index, so there's a lot of sensitivity to interest rates and the overall market. Again, great leading indicator. This is support near 35 going back all the way to 2013. We broke below that. So the question is that resistance, like you said, great question. And here's a zoomed in version of what's going on right now on a daily basis. And we roll over, right? That former support turns into resistance. Or do we get above 35, regional banks squeeze? I can't imagine a market environment where regional banks are squeezing and S&Ps are getting killed. I think if regional banks are squeezing higher into the 40s, I think the stock market overall is doing very, very well in that environment.
Okay, good to know. Do you think that the regional banks, I know that a lot of people are using regional banks, a lot of people using these regional banks to get the funding for a lot of this stuff. The bigger banks, the margins aren't there. Could there be a scenario happening where we actually are seeing a regional bank marketively go up because people are seeing that these types of banks are going to be handling this government stimulus? And other markets, like you said, we could see the stock market, the S&P go up. Is there a situation where that's not happening in your mind, or no? It's a really, really strong one, Jeremy. That's going to mean that the overall stock market's going to improve.
Yeah, I mean, listen, I can't tell you why the regional banks are going up. The market participants have their reasons. For me, it's the fact that regional banks are going up. Like, that's the real information, not so much why and the bank stimulus, right? It's that they're going up, and that's like, wow, because if regional banks are going up, so 35 is the number. You want a number? 35 on the KRE. If we're above that, it's hard to be bearish equities. That's just the truth. But let me just show you, let me expand this. So these have been the stocks that we basically put buy recommendations on half these names over the past month or so. And we're going to take a look at a few in a couple of minutes. I know you're going to ask me, and we'll definitely talk about it. But this is just a scan. These are basically the only stocks that we've been really willing to look at from the long side. These are stocks in a bullish momentum regime. These are stocks that most of them are making new 21-day highs. These are stocks that are showing so much more relative strength than all of the other stocks in the market that it really catches our attention. Some of them have to do with, coronavirus, and some don't, and some might, and we might not really understand how yet anyway, but really looking at strength. And I think that this list is a great place to start from a filtering standpoint. And we send this to our clients on a regular basis. There are different scans for different environments, as you can imagine. But in this particular environment, we're looking for stocks showing these particular characteristics.
Yeah, well, we can. I have a question. We can either dive into more of these specific stocks that you're looking into, but you've told me and taught me that the market is only as good as its lowest common denominator, right? Of the bottom part of the markets and what's going up. What are those lowest common denominators? What are the markets that are susceptible to or that really need to change in order for you to see that the markets are going to change? Maybe that is the regional banks. Maybe you've already covered that. Or is there yet another one that you're looking at that also needs to show some more strength in order for us to see that this truly is a reversal and a general market is coming back?
Yeah, so we talk about the Dow Jones Transportation Average and the Dow Jones Industrial Average, Dow Theory 101. When one makes a new high, the other one should make a new high very quickly as well. The fact that the transports were not earlier this year and industrials were was one of the many signals saying at the end of January, get the hell out of the stock market, right? All 20 stocks in the Dow Jones Transportation Average are in the industrial sector of the S&P 500, which I know might get confusing with the nomenclature. So just bear with me. These are the industrial stocks. So these are like railroads, truckers, like the aeroplane makers and stuff like that, right? So industrial stocks. Of all of this, we talk about tech, how it's 25% of the S&P 500. Financials, you can't have bull markets in America without financials. But when you do the math, the highest R squared, the highest correlated sector with the S&P 500 of all the sectors is actually industrials. So if you want the sector that moves closest with the overall market, it's the XLI. And if we are above the 2018 lows, which I can circle here, if we're above that, let's call it 61. If we're above that on the XLI, again, super hard to be bearish the stock market, and we're currently above it. So I think that's interesting. So if this fails, I think that would be a big problem for the stock market. If it holds like 35 on the KRE, I think that's incredibly constructive, Jeremy. Hard to be bearish under those circumstances.
Okay, great. Let's go into what you're looking at now as far as opportunities go. I have, I want to get into gold again. I want to do an update on that. I know we talked about that last week, and I also kind of wanted to get into I want to see like the tech sector. I think that the technology sector XLK is, yesterday at least, it fell below its 2-day moving average. So
what is it with all you California people? You're always wondering about tech. Everything's like tech. What is it with you guys?
I think more it's just the younger guy, and my portfolio represents stuff that I'm interested into. And not to mention, I mean, like, how many people are watching Netflix? I mean, I've gone to the depths. I think I've hit the end Netflix. I've seen the dark side.
Fun fact, Jeremy, Netflix is in the communications sector now, no longer in tech.
Ah, that is a fun fact.
Actually, it was in consumer discretionary before that, so it's never been in tech.
Well, now I just feel like a big idiot. I need a dunce cap. Thanks for taking me to school, JC. Live on Facebook, and this is to my Facebook feed. So I would appreciate if you can keep those bits sent to me via private text message, buddy. Just kidding. Let's get into it, man. Tell me what you're looking at. Tell me what you're thinking of the tech sector, gold, and what other stuff you're watching.
All right, so let's look at
favorite part here.
So I showed you a scan, right? What's that scan? The scan was or is stock showing incredibly positive momentum. The most bullish momentum of all the stocks, basically, is the scan. And it's gonna, so you're gonna have the highest momentum readings and the highest relative strength. So not just showing bullish momentum, but also outperforming the rest of the market, right? Which makes sense. If it's showing such high momentum in an environment that markets are getting slammed, of course it's gonna show a lot of relative strength, duh. So it just matches up that way nicely. Most of them are also making 21-day highs as of yesterday. After today, probably more of them. So let's just look at a few that I think, because they're showing all of these strength and positive momentum doesn't mean we just blindly buy them all, right? I wish it was that easy. So it doesn't work that way either. So once we have identified the market, then we build a scan to give us the stocks that we were looking for to take advantage of this particular environment. And then of those, we'll look for the best risk versus reward opportunities that are most skewed in our favor. So that if we're wrong, no big deal, we lose a couple of bucks. But if we're right, we make exponentially more than what we're willing to risk, right? That's the name of the game.
Yep.
So let's talk about Jack Henry and Associates, JKHY. And by the way, for those of you who have never heard of Jack Henry and Associates, when you run these scans, you're going to find names that you've never heard of in your life, right? That you would have never looked at, that are not on the front page of the journal, that are not on CNBC. Like, they're just not talking about these names. But if you run the right scans, these names are going to come up, right? All right, so 175 is my level. I think if JKHY breaks above 175, I think we want to buy it. And I think it goes to 230. Why do I think that, Jeremy? Because the way I learned it early in my career was that the bigger the base, the higher in space. To quote the great Louise Yamada, she'll tell you it was her boss, Alan Shaw, and he'll tell you he learned it from his predecessor. So that has been around from the greatest, going back, based on what Alan Shaw tells me, going back to the 1940s at the latest. Probably those guys learned it from somebody before that as well. Anyway, big base. I like the breakout. I love the relative strength. I love the positive momentum. Obviously, all of the stocks on our scan are showing those things. And then the risk reward is 175. If we're not above 175, no reason to own it. It's not our problem, somebody else's problem. Only if it's above 175 do we want to be long. I think it goes to 230. Let's talk about NVIDIA, right? NVIDIA had a monster move off the 2016 lows, has been consolidating for a couple of years. And what did I just say? The bigger the base, the higher in space, right? Look at this beautiful base in NVIDIA going back a couple of years. 294 is my level, 294. If we're below 294, Not our problem. Somebody else's problem.
Yeah.
If we're above 294, however, we like it long. I think it's got. I think it goes to 400. So I think we have 30% of upside in Nvidia, and then an oldie but goodie, Adobe. You wanted tech, Jeremy. You wanted it so bad.
I was gonna make you go find one if you didn't give me one. So
listen, if you look through that scan, there's a bunch of tech stocks in there. Obviously.
Yeah, I saw that. Microsoft. Yeah, I saw that.
Yeah, exactly. So 318, that's my level on Adobe. I like the stair step, right? Higher lows, higher highs. We pulled back to former resistance, momentum showing strength. There's relative strength as well, obviously, like all the ones in the scan. But the risk reward here is the one that we're looking for. So 318. If we're not above 318, it's somebody else's problem. But if we're above 318, I like it long with a target of 385. Jeremy, what do you think about that?
I'm thinking that is a nice asymmetric risk reward ratio trade per your usual fine. JC, you never disappoint in finding those. And for those of you who are joining us and you are learning about how to find these opportunities, you've stumbled across somebody who does this better than anybody else that I know. His methodology is all about taking a look at the technical analysis where everything is being considered into the price of the stock. All the stuff that we see in the markets and the news is constantly being factored in to the price that you see here. So that's what the stock market's trying to do. This is all stuff that you preach, JC, on a regular basis. And you have a methodology that is absolutely repeatable. It's constant. And it's like you've got a few tunes that you know how to play, but man, you know how to play those things extremely well. And there's always an intended result that you're looking for. What are the ways? So there's still a ton of fear. Okay, there's fear in the news. There's fear in communities. There are people texting me all the time that are pretty much perma bears. You know what I mean? They're thinking this is going to get worse. Are any short side, any stocks ETFs that you're looking at that could take advantage of the market continuing to slide?
Yeah, let me pull this up for you. So, funny thing happened last week. You know how much I love when funny things happen.
It's always seen when you start a funny thing happen. My ears perk.
So, a funny thing happened last week, and here we're looking at a chart of gold relative to the Nasdaq. So basically, gold versus the best stocks, right? It's probably the best way to put it. So here we have a beautiful uptrend off the 2000 lows where gold really outperformed for a decade. I mean, this was the gold bugs bread and butter. Like this period, like created gold bugs. Like they always look back to this period like the glory days, right? So then that popped nasty in 2011. I mean, these silver longs got carted off in stretchers. We've never heard from some of these people ever again. I'll never forget that. Silver going to 50. That was nuts, dude. So anyways,
fun fact, I have to stop because like this was actually one of the things. So that right there, what you're looking at is when I worked at this commodity firm, and I bought, and looking back on it, it was a ridiculously aggressive trade. But I bought 50 and actually started at 45, then went to 50, then went to $55 the money call options on silver. $500, JC. That's one $500 contract that on the futures market that controls 5,000 ounces of silver. We had people talk about never hearing from people again. We've had people taking like 20,000 and $50 account, and it went to the moon, man. These guys were $250,000, $400,000 accounts back then. One of the best calls I had ever made. Best trip ever in my life was on that little thing. So anyway, I had to pat myself on the back there for a second. Carry on.
So the stretcher carry trade, if you will, was up here, and then since then, gold's been the worst place to be in the world for years, right? If you haven't been in stocks for the past decade, like, you should probably figure out a new strategy, right? Because the stock market's gone straight up, and therefore this ratio of gold to stocks has gotten crushed, right? Until now. So here we have what I would consider a very just classic continuation pattern. Lower highs, higher lows. We call it a symmetrical triangle, hanging out down here below former support. Just like this has continuation pattern written all over. Like this is the sheer definition of a continuation pattern. Now, the funny thing that happened is that it did not continue. And when continuation patterns do not resolve in the direction of the underlying trend, and in fact resolve in the opposite direction, that, my friend, in and of itself is the signal. People are like, oh, JC, technical analysis doesn't work. No. Maybe it was that your technical analysis didn't work, but the technical analysis that we're doing is suggesting that what should have been a continuation pattern was not resolved higher. That's the signal. So this has my attention very, very much. Gold simultaneously is breaking out above that level that we've been identifying forever, 1580, 1600. Trade has and still is, if we're above those levels, got to be long. So if the market does collapse, right, and this ratio rips, this ratio could be ripping with both gold and stocks both falling. But the bet that we're going to make is that if stocks fall, this ratio just goes up even stronger. And I think gold does well. And then if we're going to have that conversation, then we should have the conversation about silver. And what we're looking at silver is that in 2015, we held those lows. 2018, 2019, we held those lows right around 13.5. And what happened? We broke below that last month, came back above it. The trade is, if we're above 13.5, I think we could be long silver all day on the SLV, on the ETF. And I think we go to 17, 18 bucks. It's a big move.
That's a huge move. Yeah, and that absolutely makes sense. And I was going to say, you've got to throw silver in there if you're going to talk about gold. That's the second question I get. If anybody asks me, well, I know that the next question they're going to ask me about is silver. They just tend to go hand in hand, and people are looking for both of those opportunities. Are you looking and finding anything specifically in the mine sector for those, or is it just mainly in the gold play itself?
I'll tell you why not. I actually have a chart that explains why not, if you can imagine that.
I can. That's what I love about you, JC. You're always, if there's a reason no, you have a reason. If it's no, you have a reason. If it's yes, it's a reason. So that's one of the things I love about you.
So 31 has been the level. Some of you out there in internet land have been following me for a while and know how many times I've mentioned 31 on gold miners. And why do I mention 31 on gold miners? Because every time it gets there, it collapses. Every single time. This time most recently, no different, of course. And that has been the ceiling. So my argument has been, why is everybody in such a rush to be in the gold miners if we are clearly, again, not my opinion, facts only, we are below overhead supply. I mean, that's just fact. There's obviously an overwhelming amount of supply relative to demand at 31 bucks in the gold miners index. Why is that the case? I have no idea, but I don't care either. It's just fact, Jeremy. Every time, you can't argue with me. You could be the biggest gold bug in the world and you can't argue with me. There's an overwhelming amount of supply relative to demand at 31. So until that changes, to be long this group makes little sense to me. I would much rather pay more knowing that it's on the way up, knowing that we are above the floor than below the ceiling. Wouldn't you rather pay a premium to know that,
Yeah, no, 100%. You're absolutely correct. And that's just an important distinguish between an amateur trader and a professional trader, though. You know what I mean? I feel like people don't get the consequences for swinging for the fence. You're going to go out on a limb because your belly tells you so, because your buddy texts you so, and things don't back it up and don't support it. And you wonder why your account dwindles down or you get schwacked. The worst thing that can happen to somebody is they luck in the stock market. It really is, because all of a sudden they think they're the next Warren Buffett. There's some oracle, and they start placing silly trades. And if you don't have a methodology when you trade, you're going to lose. I don't care who you are. There's sharks out there. There are people way smarter than you. There's guys like JC who are just chomping at the bit to wait for the dumb money to make a move, and if to fall apart, and he will sit there and take advantage of it, and so will all of his members. So yeah, you're definitely picking up what you're putting down there, JC.
And I wanted to talk about something briefly that you mentioned before about the market pricing in information. What the market is a discounting mechanism. And what that means is that the price of the market and all the stocks are what they are because it is discounting all of the known and unknown information. So the information that you're seeing in the headlines, I have crazy charts. You want me to show you some really interesting charts? I've got some charts on the headlines that have been, basically scaring the heck out of people. But these are the headlines you see now. They're not the headlines. Okay, Twitter's sending me a message. I want to show you guys an interesting chart. Here we go. So here what we're looking at, here we go. So here what we're looking at are all of the stories that quote 1987, all of the stories that quote crisis, all of the stories, panic, grim, dire, fear, worst, bear market. Look at all the spikes, all the historic spikes and the amount of stories that have been written with these particular words in them relative to history. So these are the types of stories that you're going to get in the headlines today, certainly not at the end of January, right? So what we saw in December, January, early February was the market deteriorating ahead of any crisis or crash. The market was already pricing that in. Why was that happening, Jeremy? Number one, the hedge funds, the largest institutions in the world, have way more money than the government and are going to start acting on that way ahead of the government releasing that information, right? That's just a fact. The hedge fund's going to get the information and then they're going to sell stocks. The government's going to get the information and then have 15 meetings over the next week trying to decide when to tell the public that information, right? Number one. Number two, even like when JFK got shot, the stock market was selling off before the news hit that the president was dead, because in Dallas, they were selling, right? The Payne Weber in Dallas was calling in the New York Stock Exchange, sell stocks, sell stocks, sell stocks. They knew something was wrong. And people were seeing on the New York Stock Exchange, why selling? Who's selling? Who's selling? Payne Weber in Dallas is selling. Payne Weber in Dallas is selling. So then that broker tells the guy next to him, Payne Weber in Dallas is selling. Something's going on. And then they sell. And then that creates more momentum, more selling. And then half an hour later or 10 minutes later, whatever it is, the news item comes out, president shot in Dallas, President Kennedy killed. Stock market had been falling apart well before that. You could see it in the data. And why is that? Because the institutions had information before the general public, and the market was already discounting the information that was about to come out, just in the same way that the market in December, January, and early February was discounting the fact that the economy was going to have this particular slowdown, unemployment was going to shoot, to historic proportions. The market falling ahead of time was the evidence we needed to know to get out. Now we know why the market was getting out. And now that the unemployment numbers are coming out and all these headlines are being written, the market goes up when these unemployment reports come out, because the market's looking at what's going to happen next month. It doesn't care what happened last month. It knows already.
Yeah, that's right. It's old news. It's the old adage of sell the rumor, buy the fact, right?
Right.
So that's basically, that was a beautiful story and really well, like a great visual on understanding how the markets really work. People tend to overcomplicate things and get lost. It really is as simple as that. People with information, knowing things, making decisions, that decision informs that action informs other people of a decision being made, and then the rest follows.
Yep.
So
and then ultimately we get the news item, with a half-ass explanation as to why that particular event happened. But they don't know, we don't know. When they say, oh, Morgan Stanley down 3% on the news, on the back of whatever, like, the journalist is lying to you. They're making that up. Like, they don't actually know that the traders are selling the stock because of that particular headline or news item. They have no idea why. So, when you're reading these headlines, just understand the journalists are literally making it up. It's their job to tell a story. They know the story may or may not be true, but they're going to tell you anyway. They have to sell ads.
That's right. That's 100% right. So I think this is a great time. I mean, every single week we're going to be coming with this type of information. We're going to be giving you updates on things that I'm personally following and investing and trading in, things that JC and his company are looking at. I want to remind everybody that what a privilege this is. I really can't tell you enough, JC, how much I appreciate your time, because you guys, he is being asked and sought out by almost every single institution, bank, and hedge fund in the world, right? Mainly here in the US, but he's working with people over in India, people over in Asia. And when I mean he's working with them, these are people who are paying him to give them this insight that we're getting right now. And with all the volatility that's happening in the marketplace, with all of the craziness, there are times where there's a lot of money that can be made. More money is being made during times of recession, in times of crisis, in times of bear markets than there are actually in bull markets. And it takes an expert, and it takes somebody with his experience. How long have you been a chartered market technician?
I've been a CMT about 13 years or so. I've been at this in general about 20 almost.
So most of you are full-time in your career. You're an attorney, you could be a marketer, you could be the CFO of a particular company, and every single day you're doing your craft, right? And in your business or in your particular field or industry, you could be somewhere in the middle or you could be at the very, very top. If you're ones at the very, very top, you know exactly what it takes to get there. JC Peretz is that in our industry. He's at the very, very top. He's at the upper echelon of anybody who would consider themselves a CMT or anybody that would use the practice of technical analysis. JC is at the top. And he put together a really amazing offer. If my team drop the link here and then also in the Facebook feed of what we are doing, that would be great. And really what this offer really is, because he's basically giving 40% off. And he also is the type of guy that gives you a money back guarantee. So you got 30 days, is basically completely risk-free. For 30 days, you can go and check this out. He puts together trade signals. So exactly what he's at, when he's looking to get in, when he's looking to get out, a complete analysis and breakdown of it. You're getting over 30,000 views blog every single month. I mean, you're getting a ton of organic traffic. How many Twitter followers do you have? Like, I don't know, 50,000, something like that, 45,000, I don't know.
60, 70,000, I don't know. 60,
70,000 of Twitter followers. And the reason is, again, it's all because of what you just broke down. You know, there was a company that knew about information that went and sold, their stock positions because they knew this information. You guys, he is the expert at finding out where this information is, how to scan for it. And he looks at nearly 5,000 charts every single week in his craft. And so this is an opportunity for you to go and hear and leverage that experience and knowledge for your own benefit. It's fast, it's easy, and it's systematic. I've asked JC time and time again, hey, do you have like some, 8-ball that you're shaking here to find out where these trade recommendations are? And he laughs and says, of course not, because he doesn't. He actually has a real trading approach. So many people think that they can read headlines and create a position, right? And trade off a position based off of reading headlines. And he just proved it to you that the headlines are old news, that they've already been factored into the market. So while so many people are looking at more opportunities to short the market on information that the stock market has already accounted for.
Months ago.
And we'll be releasing, we filmed, you and I, JC, we filmed this amazing documentary together like a month ago, a little over a month ago now. And, in the documentary, you decided to do a lesson on this trade that you placed where you exited the stock market and went long bonds. And you guys, he did this before the coronavirus hit. He did this well before the stock market slid by 30%, 20 something percent, using his methodology. He used the exact same methodology to pay for his entire wedding. And very similar, I think it was maybe the same, was it the exact same trade?
It was. It was because sometimes, this was in the fourth quarter of 2018, and same thing earlier this year. Sometimes buying bonds, depending on what the correlations look like, in those particular two instances, the correlations between stocks and bonds were very negative. So rather than shorting stocks, in both of those instances, in my opinion, it was the easier trade was to buy bonds. Like the sexy trade, the ego trade was to short stocks, but the easier trade was to buy bonds, both in the fourth quarter of 2018 and at the end of January this year. Both times, in my opinion, it was just cleaner. The risk reward was better defined. So who cares, whether you're shorting stocks or buying bonds? What the hell's the difference?
Yeah, exactly right, man. And it was beautiful. It was prophetic. And it's stuff like that that's gotten your name everywhere, man. It's gotten the attention of people who manage billions of dollars, who are arguably some of the best traders and investors in the world. You've gotten their attention because you have this knack for consistently doing that over and over and over again. And it's just because you're a student of the craft. You've applied the principles that you've learned, technical analysis provided for you, and it produces big results. We have a couple people that I know that someone raised their hands. William asked, is with the All-Star Charts promo, does it include the All-Star Charts option premium service? The answer to that's no. This is for JC's, this is their like flagship service. There is another service with their option premium service, but do you want to talk about that for a second, JC?
Yeah, I think it's because the slide says options premium. What we do for our premium members, what Jeremy is describing, with this special offer the team is putting the link there for, Sean does provide our premium members with specific trades as well, probably about once a week, kind of just like as an added bonus. But that's the All-Star options, if that's more option specific, while the premium that Jeremy's describing is really the research. You get access to my chart book, our monthly conference call, which we're having next week, which I'm always very excited for. And it's always a thrill for me to prepare for because, our members really like our monthly conference calls. It's an hour long where we go over all the global markets, all the different asset classes. We have individual trade ideas, cryptocurrencies, bonds, commodities, currencies, all the U.S. sectors, all the indexes around the globe. But it forces me to really put my ideas down on paper, really build a story and a thesis. It forces me to take a step back. I got to tell you, as much as our members love this, Jeremy, if anybody's winning on this, it's me. I promise you. The process alone is a huge home run for me, no doubt about it. So I'm happy to do it, and I really enjoy it. In fact, as soon as I get off with you, I will start putting that together because the market just closed, and it's a holiday on Friday. So the weekly charts are here, and I got my work cut out for me. We got all sorts of scans we're building with the anchored volume weighted average price off from the highs. We got some cool stuff that we're about to be dropping.
Yeah, I love that, man. And what I would love it too if I was you. It's how you make your money and lots of it. So by reviewing those charts, it's like, all right, I'm going to find more ways that I can make some more money. And that's another thing I love about you, dude. It's like you're passionate because it's charts and it's an art and a science, but it's an art for you. And it's like, somebody who wants to play guitar all day long, you like to look at charts all day long. The byproduct is that you can help people change their lives. You can change their lives by providing additional income stream, by finding, asymmetrical trades. What we mean by that is trades and investment opportunities that have a really, really great upside, a lot of profit opportunity, where the probability of losing on the trade is low, and the amount, if you are going to lose, is relatively low. The probabilities are, right? Of course, is there risk investing? Absolutely. Should you trade or invest with money you can't afford to lose? Absolutely not. One of the famous things I used to tell people when I was a financial advisor was that if you're trading, imagine taking that money and putting it in your front lawn and setting it on fire. How would you feel about it, right? Of course, you'd be upset, But if that's going to cause you financial hardship, then obviously don't trade, don't invest, don't be a part of it. All right. If you're going to be upset, but it wouldn't cause you financial hardship, then why not try to maximize those dollars as often as you possibly can and be ruthless with it? Be absolutely ruthless. JC has said it several times. I don't know why this, I don't know why that. He doesn't care. He knows that this is probably what's going to happen next. And here's how my money can turn into more money. And he constantly positions himself that way. He positions the institutions and hedge funds that way, and he can position you that way too inside of your portfolio every single day. He can. What's more important, JC? What do you think is more important, getting into the trade or getting out of the trade?
You want to know something, Jeremy? You know what I think is most important? I think what's most important is recognizing that we're going to have another opportunity. Right? Because entering the trade, exiting the trade, very important, right? And most importantly, you want to predetermine where you're getting out if you're wrong and where you're getting out if you're right. That needs to be predetermined before you get in. You can't just buy something and then just like reevaluate every week moving forward and justify reasons to hold a loser. That doesn't work. If we're buying it at 75 and we say, okay, if it's below 70, we're out. Well, if it's at 69, we're not in it anymore. And if we buy it at 75 and say we're going to sell it at 100 and it gets to 100, we're selling it. Like, we're not just going to be like, well, maybe it can go to 200 now. No, it doesn't work that way. So I think both are important. I think being disciplined, staying disciplined, I think is certainly most important. But what I think gets forgotten, Jeremy, and you talk about, you laugh because like I get excited and enthusiastic and I can't wait to go look for more ideas. That's the thing, is that there's always going to be more ideas. The market doesn't guarantee us a lot of things. What it does guarantee us is more opportunities in the future. So if you miss something this week or last week, or if you missed this trade or screwed up this cycle, you're guaranteed that next week there's going to be a lot more opportunities, and the week after that, and the week after that, and the week after that. So as Warren Buffett said, there are no called strikes on Wall Street. You don't have to swing. You could stand there on the batter's box and keep taking pitches all day long. You don't have to swing. You don't get penalized for not swinging like you do in baseball, right? We have all the time in the world. And some of these institutions, particularly the long-only community, they can't go to cash. They have to take swings, right? They can't short stocks. They have to be long at all times. As individual investors, you don't have that mandate. You could do whatever the hell you want. You want to go to cash? Go to cash. You want to short stocks? Short stocks. You want to buy natural gas instead of stocks? You could do that too. You want to buy bonds, right? You can do anything you want because you don't have a specific mandate. The only mandate that you have is to yourself, to manage risk responsibly. That's the one mandate you have. And you can do that across asset classes. And you know that another opportunity is coming. You know it's coming next week. No doubt about it.
Yeah, that's really cool. I love that. I like thinking about the stock market like a series of pitches, and I'm standing there as the proverbial batter, and I can see Microsoft and I can see Netflix and I can see these different stocks, aka pitches, come at me. I don't have to swing, and I can swing. And it's more knowing that there's always going to be another pitch. That there'll be, if you don't love that one or aren't really comfortable with that one, don't understand that one, or afraid of that one, don't have the funds for that one, you don't have to go and swing at it. So that's pretty profound, man. I like that.
Yeah, it's not like the bar is closing and you got to make sure you talk to the pretty girl before, it's the last call and you got to leave. It's not like that. Like, the pretty girl's going to be there forever. She's not going anywhere.
Yeah, right. Or there might be a hotter one that comes in.
Definitely.
So I want to do something. If anybody is willing to do this, as we get to do more and more of these Zoom calls, that one of the good things about doing Zoom is that we can allow people to talk. So you can raise your hand if you have a specific question. I'll open up your mic if you're connected to one. Or what you can do is you can put in your question in the Q&A. And you can put it in as an anonymous question, or you can say it's specifically for me or JC. One of those questions, and if we don't have questions today, we don't have to go into it. We're doing these every week. But one of the questions was what do you think of DocuSign? So if you want to maybe pull up a chart on that. I know that that's actually been a hot one. It's been talked about several times between you and in the markets.
So what I like about DocuSign, obviously the positive momentum and the relative strength. There's no doubt about it, right?
Yeah.
So here.
And while you're pulling that up, if anybody has any, like I said, questions, comments, let's make this a good conversation. And if you're on Facebook, I've got my feed coming up. Let me know what you think, and I'll try to take your Facebook questions as well.
All right, so you see this? So this is DocuSign. So what we're doing is we're taking the highs from 2018 down to the lows, right? There's that fourth quarter decline in 2018. We broke out in the fourth quarter last year, a year later, we break out. We hit the next extension level. I can actually make these bigger for you. We get to the next extension level near 89.90. We stop going up, not a surprise. That's pretty standard. We've been consolidating. We found support near former resistance. Again, all standard stuff. This is the stuff you learn in technical analysis kindergarten, right? We've consolidated nicely, and now I think we break out. If we're above 90, I think we could be long all day with a target near 123 in the DocuSign. I like the relative strength. I like the positive momentum. And most importantly, as usual, I like the risk reward and that it's skewed in favor of the bulls. Not to mention that we're not trying to pick a top. The trend here is up. So the probability of that trend continuing is much higher than for the trend to completely reverse. And the positive momentum and relative strength supports that case. And then the risk reward provides us with a great opportunity to make money if we're right. And in the off chance that we get it wrong, it's no big deal.
Love it, man. Love it. Great. There you go. Hope that answered your DocuSign question. What about KRE?
Well, we went over KRE. That's the regional banks. That was the first one we looked at, right?
Yeah. Now it's 35. Would you go long next week?
Well, yeah, totally. I like it long if we're above all that support. I mean, I can't speak on behalf of anybody else, or, I don't know the objectives and risk parameters and all those things of the people at home. But if we're above 35, I see no reason not to be long.
Great. Perfect.
Probably good for the market overall too. So, most things that you're long will probably do well.
Yeah, good. We've got some more questions coming in. This is great. All right, so let's see. And then that's way out there, but we'll throw it up. I don't know if you can see these questions. Can you see these Q&As too, JC?
I can see some.
Go to the Q&A tab, open the thing up, and maybe you can. So there's one that says, okay.
The Christmas stockings, like that?
There's one right there. Yeah, there's two. So there's the, this is Christmas, may see a lot of coal in people's stockings. Which toy companies are going to weather the Christmas storm and which ones are going to hurt the most?
Christmas storm? It's April.
I know.
What Christmas?
Out there.
I guess I'm not really understanding what
they're saying. Is there any, like, I guess he's specifically looking at it, if there's any toy company. I mean, Christmas is so far out there. I don't even know.
I don't know. You got me there.
Yeah,
I'll worry about Christmas after Thanksgiving. How's that? Can I just get Thanksgiving first? Can I get my turkey before we start worrying about Christmas? My wife loves Christmas carols. It's like Christmas carols for months. It's like I haven't even finished my turkey and Mariah Carey's already singing up a storm.
Yeah. Yeah. Are you an early or a late Christmas gift buyer?
I got charts to look at. I'm not an early. I wish I was better about that, but that's not me.
Yeah. Same, man. I'm pretty late, fortunately.
They want to look at SPY, right?
Yeah.
They want to look at SPY.
Yep.
So I'm looking at these levels right here, and I'm looking at these levels right here. Those are the levels. It's 2650 to the downside. If we break below that, market's probably in a lot of trouble. And then the next stop is right around that 2950, 3000. There's a lot of market memory there going back, way back, going back to the 2008 highs. I mean, there's a lot of market memory there, right? So this is where, if you notice here, All right, so you had your breakout from this consolidation above the 2018 highs, right at that level. It's the 61.8% retracement. I can actually make that bigger for you guys so you can see it. So you got a big retracement right there, that 2950, 3000. So I think there's going to be a lot of trouble there if we can even get up there. But I think that we can. The path of least resistance is still higher. But if we break 2650, we probably want to reevaluate that bullish thesis. And I think the way to take advantage of the fact that we don't know, right, is to be in the ones that are already working. Like, I don't think we need to be cute and hope that the market agrees with us down the road. I'd rather be in things that the market already agrees with me on, right?
Yeah. I mean, this is a personal question. I've ever asked you this before. I mean, are you really ever in things like the SPY? Like, are you in these bigger things, or do you go into the specific? Because I know your strategy, you go macro, you look at the whole picture, and then you go down into sectors, and then inside the sectors, you go macro sectors, and then you're looking for like I mean, do you ever stop there and be like, oh, I'm going to go long the SPY, or would you much rather go into a specific company that you think has the strongest momentum? You know, which one of those do you normally do?
For me, it depends on strategies, right? Like, we have retirement accounts and stuff like that. Here, let me show you. We have retirement accounts and stuff like that. And for those sorts of things, I think the S&P 500 10-month moving average strategy is beautiful, right? So for, you're asking me about whether I do that or not. Yeah, absolutely. And then here's how I do that. I feel like we talked about this before and you just threw me an alley-oop, but this was not pre-planned. But basically, when you talk about the S&P 500, here we're looking at a monthly chart going back several decades. And then we're very simply putting a 10-month moving average. That's the blue line. Very simply.
See it. Put there, JC. I can't share your screen.
Oh, you were not able to see it? Sorry.
No.
How about now?
I got you.
All right. So we're looking at a monthly candlestick of the S&P 500 going back a few decades, and then a 10-month moving average. Okay. And it's very simple. These are a nice long-term trend-following system. You own the S&P 500 if it's closing above that line, and you are raising cash if we are below that line. So cash below the line, long S&Ps if we're above it. That's simple.
Love it. Great. So depending on the strategy, more long-term, you'll look at bigger chunks of the market. And look, obviously pull the thing back for bigger long-term trend changes. And as you're looking for more aggressive pop term swing trading type trade, you'll keep going micro.
Yeah.
Stock. Okay.
Yeah, no question. So the analysis is top down. So we start with the global averages, then go to the US averages like S&P and Dow and NASDAQ, Russell 2000, all those. Then we break it down to the sector: energy, financials, industrials, healthcare, communications, all of those. And then we break it down to the sub-industry group. So healthcare, you've got medical devices, biotech, pharma, managed health. If we're looking at financials, you've got regional banks, broker-dealers, exchanges, insurance stocks, right? If you're looking at energy, you've got oil services, you've got the explorers and producers, you've got the integrateds, the refiners. So you've got industry groups within the sectors. And then ultimately, let's just say in my infinite wisdom, I decide that we probably should be in large cap tech in the US for whatever reason. Then we'll look at large cap US tech stocks. And then we'll be looking at Microsoft and Apple and Visa. And then we'll be like, wow, look, Microsoft provides the best risk reward, or Visa looks like the best shorting opportunity. We'll break it down to the stock level. And then I think that what the beauty of our research is that because it's a top-down approach, depending on the investor's prerogative, they can stop at any of those points. So I know a ton of financial advisors that are our clients, and they just do the sector stuff, and they just rotate the sectors for their clients using the ETFs, and they'll just stop there. I have a lot of other clients who don't care about the sector work. They just want the stock trade ideas. They're stock jockeys through and through, not ashamed of it, right? And then there's people like, I got clients that they don't care about either one of those, right? They don't care at all about it. They just want to know if shit's about to hit the fan, JC's going to be there waving the flag, because they got stock portfolio, private equity portfolio, real estate. They got $10, $15 million worth of exposure, or $500,000 worth of exposure, or whatever it is, and they just want to know when to get defensive, and if we do need to get defensive, and they're good with that alone. So I think that as a function of our process, we are able to give a lot of different people what they're looking for.
Yeah, I love that. Do you, 2 more questions. We'll take one more after this one, you guys. So if anybody has another one, please put it in the chat feature. If anybody on, you're getting a shout out here from Paul on Facebook saying JC dropping knowledge.
All right, Paul.
Thanks, Paul, for watching. And here's one of the questions, just because it's on the same topic. We'll start with this one. Do you use 10-month moving average strategy on other indexes, ETFs, say the QQQ, gold, the semi?
Listen, this is a long-term trend following strategy that you can incorporate in any asset class. And by the way, just because I use a 10-month moving average doesn't mean you can't use an 11-month moving average or a 9-month moving average or a 40-week moving average. There's no right or wrong way to do this, right? So let this at the very least inspire you to create your own trend following system, and you could back test the hell out of it and make as many tweaks as you want. I would just maybe reiterate some of the benefits of keeping it simple, particularly avoiding whipsaws, avoiding like, oh, it told me to sell, now it told me to buy, now it told me to sell, now it told me, these long-term trend following systems, I find them to be much more useful the fewer the signals, right? And that's what this is. But feel free to incorporate it into any asset class and change the time frames if these monthly charts are too slow for you, which to many traders, I know a lot of traders who would never look at this chart.
Yeah, right. Like, wait, now that's way too long term, JC. What's going to happen tomorrow and how can I make money from it? Yeah.
So look at a 10-minute chart and look at a 10-minute moving, a 10-hour moving average or something like that, whatever. But it's more of the concept than so specific. I hope that makes sense.
Yeah, we'll do a little foreshadowing. It would be really nice, JC, if you had, I don't know, maybe a course that we could, learn about this and try to incorporate that. You should really think about, maybe making one of those with trade stocks and putting on all-star charts or something. I don't know, just maybe a little foreshadowing on something you should be thinking about doing.
I got to tell you, I appreciate dropping some hints. We've got something pretty special that's about to drop, and I'm pretty proud of it. I had some high expectations because I have experience with some of this educational stuff before that I've done for other outfits, and this is the first time that I did it for ourselves. And I had some high hopes, but the team really pulled through, and this thing is looking good, Jeremy. I'm serious, man. I'm pretty excited about it.
Anything that makes you excited gets me excited, my friend. I've learned to pay attention when you say something's going to happen because it does. All right, last chart, last signal, or should say last ticker symbol is from John here. John's asking, JD, what do you think of INSG? INSG. I'm going to look it up too.
INSG and Sago Corp.
That's what I'm getting.
Just make sure it's not like a penny stock or something I shouldn't be talking about. Market cap 900 million. Sorry, too small for us.
Yeah, I was just about to say no.
A little too small for us. We stay away from that sort of thing.
Tell people why. I mean, this is because we really appreciate the question. I'm not trying to shoot it down, right? So, I'm all good with that, but why is it something that we, John, this is just for you, man. We want you to understand this. And for anybody else who's going to ask us questions like this, I love doing these things with JC, and we pretty much are open books. I mean, we'll talk about a lot of stuff, but there's certain things that we don't really get into, and there's reasons for it. JC, why don't you take away why it's, these types of stocks are just stuff that you don't like to comment on?
Yeah, generally speaking, if it's below $1 billion, I stay away from it in terms of talking about it. This one in particular trades a lot. So it trades, it's traded 6.5 million shares today. So it's not that illiquid. So normally I wouldn't do it, but for compliance purposes, we just stay away from that completely, just so that you know. From a trading standpoint, if it was illiquid, I would be more shy about trading it. But this one seems plenty liquid, so just at a glance, I would not avoid trading it for liquidity purposes. But I just wouldn't talk about it simply because of market cap.
Yeah. So that's it. There's not any particular it's definitely not something he wouldn't be able to go and do, but compliance purposes and for other reasons, there's certain, again, this guy is being sought after by banks, institutions, and hedge funds and things like that. His knowledge is a double-edged sword. It could be used for good, and it could also be used for bad. And there's just certain circumstances where you could give as much advice as he possibly wants to give, but the float isn't big enough, and someone could get really, really hurt. So, and that's not what we're in this to do. In fact, we're trying to help people to get hurt. We want people to make money in trading and investing. In time, there are certain things that go just a little bit above the tolerance, or I should say, sometimes more legal compliance, parameters that fit our scope. But great questions. And JC, I told you I was going to bring some hot questions in today, and I was pumped up to speak to you. I've been following these markets like a hawk and really enjoying our conversations. I'm taking these findings to get as a member of All Star Charts and applying them to portfolio, also taking them that you and I talk about and making adjustments or just things on my radar. And I can't tell enough how excited I am. And for anybody who is not a member, I have to tell you, there is a way to get involved. It is super easy, completely risk-free. Someone asked a question, hey, if I signed up after 30 days and I didn't want to renew, could I? Yes. If you were, let's say you're 10 days into let's 24 hours into going to JC's website, and you just think that his strategies, his techniques are wonderful, gladly refund your money, and you can move on. I don't know if you've been around and you've gotten a part of and invested in yourself and bought subscription services. There are some players in the space that don't do refunds. They just refuse to do it. JC puts his money where his mouth is and says, you know what? No, I would go for it. You want to ride? You want to test drive this car first? I'd love it if you could do that, because he knows and stands by the amount of education and information that he gives to people. So I can personally test for it. I love it. And I recommend it. So take a risk-free trial, join his program. The link is here inside of the Zoom. Put in our comment section on Facebook if you're watching this there as well. JC, any parting words for us?
I think just markets aside, we're all, civilians and, Americans or, citizens of our respective countries around the world. Some people are going to come out of this stronger. Some people are going to come out of this weaker. That's just the way it is. I would prefer to come out of this from a better position of power, from a stronger position, healthier physically, healthier mentally, business healthier. So those are really the things that I'm thinking about. I hired an accounting consultant to, help clean up my the accounting, to have less work for the people that are in charge of that at my firm. So I'm making my business healthier. I've been doing a lot more yoga. So physically I'm healthier. And then, just making sure that I'm putting in the work on a daily basis, not just for myself, but for all of our clients around the world, and just handling my responsibilities. And fortunately, I enjoy doing those things. So I have a huge advantage in that. But think about sort of your own situation, your own career, your own family situation. How can you come out of this better than you entered it?
Well said, man. Yeah, we are. There is a real crisis happening, and there are people's lives that are really being affected by this. And there's a lot of us who are going through the motions and trying to do the best we can. And that is a really, really look. I appreciate you sharing that. It definitely helps me, stay positive and think of ways that I can try to capitalize on this time, with my family and just what's going on within my own, what I can control. How can I make it better? So
That's right.
well said, man. I really appreciate that. For any of you who are attending that are front lines in the medical field, a big round of applause to you, and thank you so much for your service. If you're watching and you're a part of this, just thank you from the bottom of our hearts for putting yourself at risk to help other people. You guys are the true heroes. So thank you all for attending. My hat's off to you too. You know, you guys could be doing anything with your time. You could be trying to find the bottom of Netflix, but you're not. You're here watching about the markets and talk about what we're passionate about. So my hat's off to you for taking action and wanting to better yourself, better your family, and create a legacy for yourself. So congrats to you guys. Guys, allstarcharts.com. The link is there. William, John, a couple other people that have been commenting. Please come back. We're going to be taking this all live on Facebook next week. So we're going to remove the registration. So get on Facebook, follow tradestocks.com, follow All Star Charts, and we will be pushing this live. So you guys are amazing. Thank you so much for the compliments, the feedbacks. We do it for you. Have a really, really great rest of your week. And we'll catch you guys on the floor. AC, you're the man. Stay cool. Stay profitable. See you online, man. See ya.